Hello everyone. Welcome back to another episode of The Week in Charts. I'm your host, Charlie Bilello, bringing you the most important charts and themes that I'm seeing today in markets and investing. A lot of important charts this week, one of the wildest weeks I've ever seen following the market, so definitely stick around to the end. And if you're watching this on YouTube, take a moment, hit that subscribe button for all of the latest content from us. We just crossed above 25,000 subscribers, so thank you everyone for subscribing. A lot more good content to come. What are we going to be discussing today? Signs of capitulation, many different signs. We'll run through them. One of the craziest days in market history, just an unbelievable move in this day. We'll discuss that. Expect more volatility. I don't think the volatility is over, and I'll tell you why. Number 4, easing inflation. We got the CPI report, better than expected in terms of prices moving at a slower rate in terms of the increase over the last year. The Fed put to the rescue. That's a question some are talking about. They definitely were talking about it more earlier in the week when the markets were much lower. And we'll end, as we always do, with something positive, and that would be rising real wages in the U.S., a theme we've been talking about now for almost 2 years. Okay, signs of capitulation, many different signs to talk about here. Number 1, let's talk about the absolute crash over a 4-day period ending on April 8th of this week. We saw the S&P 500 go down 12%. This is on a closing basis, and you can see the list here. This is since 1950. It was the 12th biggest 4-day decline for the S&P 500 index, and in rare company here. October 1987, of course, most famous for the stock market crash. October 2008 during the financial crisis, March 2020 during the COVID crisis, and then you have a few other dates here: November 2008, August 1998, the LTCM crisis, and 2002, a couple of months before the end of that bear market. So very rare company here to see this type of decline over a 4-day period. So I wanted to look back and see, well, what has happened in the past, a year later, 3 years later, 5 years later, following these biggest market crashes. And you can see every single time the top 15 crashes, the market has been higher over the next 1, 3, and 5 years. So certainly not a guarantee. Anything can happen over the next year, 3 years, 5 years. But in the past, this level of capitulation, this level of panic has been followed by a rebound in the markets and better things over the next 1 to 5 years. And I often get the question, well, what has happened over the next week or the next month? And you could throw all of that out. The market can definitely go lower from here in the short run. No one is arguing that this has to be the low. When you look out longer term, though, especially the 5-year period, most likely market is going to be higher over the next 5 years, and likely substantially substantially higher if history is any guide. What else do we have here? Well, we have one of the worst starts to a year in history. You could see the 4th worst start. This was through 66 trading days. The S&P 500 was down 15% on the year. Only 2020 at that point in time, 1939 and 1932 had a worse start at this point in time. And what did the market do following those top 3 there? You can see through year end, the market actually rallied. And even looking at 2001, market not much lower to the end of the year, and you got 38, and 2009 obviously much higher. So doesn't mean the market has to end the year higher from here, but certainly you could see more often than not the market actually goes up throughout the remainder of the year, and often significantly so. So it's not preordained what's going to happen between now and the end of the year. Anything can happen going forward, and the odds seem to favor actually some type of rebound. Let's talk about the VIX here. Just an incredible move. So we talked about one of the biggest 4-day declines for the S&P 500. Well, on the flip side, if we look at the volatility index, the fear gauge, the VIX, it started 4 days ago, 21.51. And then at the close on April 8th, it was up over 52. That was a 143% increase, good for the 3rd biggest 4 day increase in history. The VIX only starts in January 1990, so you don't have 1987 in this data set, but you can see here just extreme short-term panic driving volatility higher. When that happened in 2015, when that happened in 2018, when that happened in 2020, you could see the market going up over the next 1, 2, 3, 4, 5 years. The only exception here in terms of these gains, and certainly not as big of a VIX spike, would be in February 2007. And of course, a year later, the market was in a bear market, and you had the 2008 financial crisis bringing stocks down. But with the exception of that, every other time the VIX has spiked this much in a 4 day period, you see the market tends to be much higher a few years later, and 5 years later, again, with the exception of this 2007 one, substantially higher. Let's talk about the VIX in terms of levels here. Closed above 50 on April 8th. Just historic here. We've only seen this a few other occasions. I listed all of them here, but really most of them have happened in October, November 2008, in March 2020, and we have another one, of course, here, March 2009, February 2009, and now April 2025 will go down in history, one of the highest closing levels for the VIX ever. And you could see a lot of green on this table. Very rare to see this for any indicator. Looking at 1, 2, 3, 4, 5 years, what do we tend to see? We tend to see the market bounce back, in fact, every time following this high level of the VIX. And you can see here the averages for closes above 50, well above other periods. So looking out next 1 year, 35% return on average for the S&P 500, 3 years, 55%, and 5 years, 129%, well above average, as you can see down here, looking at the differentials. So last reading here in terms of capitulation, this is an important one because it really indicates that there has been wholesale selling. So when they're selling everything, consumer staples, healthcare, utilities, along with technology, financials, and they're just pretty much selling everything, saying, get me out of whatever I'm in, doesn't matter what it is. You see this tend to collapse, this percentage of stocks above their 50-day moving average. And what we saw this week, it reached a low of 6. Not the lowest level we've ever seen. I've indicated some of the other periods in 2022. We got as low as 2%, in 2020, 1%. So certainly could go lower than we saw, but that's pretty low. It's lower than 98% of historical readings going back to 2001. And when we've seen this in the past, this level be below 8%, which is in the bottom 2% of readings over the next month, 3 months, 6 months, 9 months, 1 year, 2 year. On average, not every time certainly, but on average, the market tends to bounce back and it tends to have above average returns going forward. So signs of capitulation all over the place for the market. And we actually, during the week, very briefly, but still hit it, so it's notable, we actually went into bear market territory with the S&P 500 crossing below that 20% decline from its peak on February 19th. So it actually hit 21% on the lows on April 7th. And what do we have in terms of the reason? If you're watching this, you know the reasons that they're attributing to this: tariffs, trade wars, and fears that that's going to lead to a global recession. And you can see, very interesting here, since March 2009, we've seen now 1, 2, 3, 4, 5 of these bear markets, but we've actually seen 4 bear markets in the last 7 years for the S&P 500. So we got the 2018 one from September to December, the February, March 2020, which was the fastest bear market in history, and 2022, a little bit longer, 27.5% decline, and now we have this one, which is actually the second fastest bear market, second fastest move from an all-time high to a 20% decline in history. And 4 bear markets in 7 years, much more frequent than we've seen in the past. As you can see in this table here, the 20% or more bear market happens about once every 4 years on average. And now we've seen four of them in the past 7 years. So much more frequent. And that's just a function, I think, of just rapid moves to the upside and then rapid moves to the downside. So following this 2022 bear market, we were talking about 2023, 2024, very abnormal years to the upside. We had above 25% returns in both of those years. And now we're seeing the flip side, the market giving back some of those gains. Okay, I want to talk about what happened next. So we've seen all of this, all of these signs of capitulation early in the week. What happened following that? Well, we had one of the craziest days that I've ever seen following the markets. Been following the markets for over 20 years. This day is a day that I'll definitely always remember. You can look here at the S&P 500, and it started the day just trading sideways, not doing anything of note. A lot of people were waiting for this. We were talking about it. This was the day that the tariffs were set to go into effect. I don't know if they actually ended up charging any of the tariffs on the imports, but regardless, there's this announcement here. You could see when it occurred, President Trump put out a post saying that the new tariff rate will be dropped to 10% for all of the countries except for China, but they were going to increase China to 125%. And then he also noted that there was going to be a 90-day pause on the higher planned rates above that 10% level. So that was the perfect setup given all the charts that we just showed. You had the VIX above 50. You had one of the biggest crashes 4 days that we've ever seen. You had sentiment obviously extremely, extremely negative, and people weren't positioned for a move in the opposite direction. They were looking essentially for any good news for the market to rally, and boy, did it rally between this point and the end of the day. Just a huge, epic advance. The market ended the day 9.5% higher on the day, one of the biggest moves to the upside that we've seen in history. And what are people saying was the reason why Trump so quickly reversed course? And this is not certainly a final deal by any means, but why did he reverse course? A lot of people are saying it's because the markets got his attention, that people were getting in his ear saying, especially the bond market is moving in the wrong direction in terms of what they had wanted. So they had been saying all along that they wanted to get the 10-year Treasury yield lower. That had been working. And even as the stock market was declining last week, which was a pretty bad down week, the 10-year Treasury was moving lower. Well, that reversed course massively this week, as you can see here, entered the week below 4%. You could see what it did in just a few days leading up to that tariff announcement. It shot all the way up to over 4.4%. And the thinking there is that they didn't want to see the bond market continue to sell off, yields continue to rise. And so he did this about face and gave some time and did this pause for 90 days. And the Treasury yield immediately went lower, but interestingly, at the close on Friday, it actually bounced back, and you could see still substantially higher in the week. So why are they saying that Treasuries are selling off? Normally, when you have a big risk-off move, you can see what normally happens is what we saw last week, which was you see 10-year Treasury yields move lower, bonds rallying on that risk-off scenario. Why is it moving the opposite directions? A lot of theories here. One of the big ones is that either China or Japan is selling off their holdings of U.S. Treasuries. So let's take a look here. What's the breakdown between U.S. holdings and international holdings in terms of who owns the national debt, who owns these treasuries? 28.2 trillion is U.S. owned. 8 trillion is owned internationally, so 22% of the market. And I'm breaking down as of January by country. Obviously, U.S. far and away the biggest holder, but you have Japan over $1 trillion, China 0.8 trillion, United Kingdom 0.7. So Do we know for sure who's selling it? No, but there's a lot of rumors, a lot of speculation that Japan or China is selling off these treasuries essentially as leverage to say you have to come to the table and you have to move closer to us in terms of these negotiations. And perhaps it worked, but it didn't seem to work for China so far because the tariff rate was elevated to 125%, and then China responded by raising their tariff rate on the US, and then the US announced another increase to 145%. So a lot still going on, certainly no settlement, but the market rallied enormously on that move. You had one of the biggest S&P 500 moves higher, 9.5%, and you had the VIX decline here. You can see biggest volatility crash in history for the VIX. So it goes from 52, as we said, very rare to see it above 50. The next day it closes at 33.62, one of the biggest volatility crashes in history. And I just look back historically, what has happened with the market going forward. Certainly not 100%, but more often than not, the market's actually higher 1, 2, 3, 4, 5 years later following these volatility crashes. The exception would be the 2007 example and 2006 because of that financial crisis data. But we really haven't seen the VIX start above 50, then have this crash and not have the market rebound over the next 1 to 5 years. If you look at the 2008 example here, if you look at the 2020 example when the VIX was elevated, you can see what the market did going forward. Very strong returns. And here's where we are in terms of the S&P 500. What happened that day? Just incredible move. You could see it erased the prior 3 days of losses just in that one day. It's a day that's going to be remembered for a long time for market participants, one of the wildest days in history. Now, here's the question. Is it over? Is the volatility over? Absolutely not. Volatility doesn't go right back to normal when it's this high. So certainly, hopefully, and it's already been lower than it was earlier in the week. But what you tend to see is continued volatility for some period of time because volatility tends to cluster. So after that big up move in the S&P 500, the next 2 trading days, big volatility, both of these trading days, not as big as that 9.5% move higher, but still above average volatility. And you can see in this chart here, I'm showing you the best and worst 100 trading days for the S&P 500. And what you see historically is clustering. So you tend to see these best and worst days occur very close to each other. And that's just simply saying that when you have volatilities high, it goes in both directions. You have big declines and you have big moves higher. This is one of the reasons market timing in a bear market, in a highly volatile market, can be very tricky because you could be selling out at the lows. Market could snap back in the other direction very quickly. We, of course, saw that again this week. And so the big question I would say is what will happen going forward with those tariff deals? We have the 90-day pause. We have the escalation with China, and that's not a small deal in my view because China is the third largest trading partner with the U.S. And if China and the U.S. don't come to an agreement in the next few weeks, you're going to start to see disruptions in terms of the supply chain and many other things. So you can't simply replace all of the goods that we're importing from China without there being significant ramifications for many, many different companies. So the expectation, I would say, based on the relief rally that we've gotten, is that there's going to be some type of agreement very shortly, or the volatility is just going to continue to be crazy back and forth until we get more certainty in terms of where will that tariff rate end up settling out, not just for China, but for all these other countries. And the market's going to move on headlines, it's going to move on tweets, it's going to move on posts because everyone's waiting to see how these deals are going to shake out. So what's going on in terms of the real economy? That's the big question. What is going to be the impact to the economy? And so far, we just have sentiment kind of data, and it's not very good. If we look at the University of Michigan Consumer Sentiment Index, today it hit its second lowest level ever. Only June 2022, which was when inflation in the US peaked at over 9%. That was the only time in the history of this index, this survey, which goes back to 1952, the only time it was lower than today. So obviously, people seeing the headlines about the tariffs, getting scared, and their big fear seems to be that we're going to see higher prices. You're talking about people expecting now in this survey, over 6% inflation over the next 12 months. Now, of course, those expectations could be very wrong, but that is the fear that's driving consumer sentiment much lower. And the big question, of course, is are they just being afraid and responding as afraid, or are they actually going to take action and start pulling back? And so far, it seems to be on the sentiment data from that survey and just reading reports, people seem to have pulling forward their purchases because they're thinking about higher prices. So I haven't heard just yet that this is translating into real activity, saying that people are pulling back because they're worried about a recession, worried about losing their job. That is going to be the big concern. If that starts to happen, that I think will lead definitely to a pullback in demand. But so far, we have this soft data. We haven't yet seen it in the hard data. If we get a retail sales number that shows a collapse, or we see consumer purchases in the PCE data show a real collapse, I think that will spook the market a lot more than just this sentiment data. And for good reason, because the sentiment data tends to be a contrary indicator. The consumer tends to be the most bearish during stock market declines, during bear markets, during bad news in the headlines. And you can see historically what has happened in the past following very low readings in the sentiment indicator. The stock market has its best returns when this consumer sentiment and its lowest 5% of readings, which of course we're there now, second lowest reading ever. And the stock market actually does the worst in the highest 5% of readings. And even that last reading, if we go back to June 2022, of course, it was in the midst of a bear market. S&P 500 was down over 20% by that point. If you looked a year later, of course, stocks were significantly higher. 2 years later, much, much higher, back at all-time highs. So will that be the case again? We have to, it remains to be seen. But the big question again is, are consumers going to start really pulling back in terms of their spending, or are these just fears and they haven't yet acted upon them just yet? Okay, with the Atlanta Fed here, they're continuing to suggest that that first quarter GDP number is going to come in at a negative level. Why are they saying this? They're essentially saying it because of net exports. We're going to see a huge decline in net exports, and that's because companies have pulled forward their purchases in anticipation of potential tariffs, and that's going to lead to a trade imbalance in the first quarter and cause a negative growth rate. Now, if there's a tariff deal and all of this is resolved and we're in a better place, this should theoretically snap right back in the other direction, and perhaps substantially so in the second quarter. There's not real clarity whether that will happen or not. And will this actually be accurate in terms of where GDP will be? That remains to be seen, obviously, as well. We're at negative 2.4% for this estimate, and we still have a few weeks more of data before we get that number for the first quarter, the actual number, the first reading in terms of the U.S. economy. So we'll see. Expect volatility to continue. Be prepared for it. Have a plan. And if you're thinking about your portfolio, you're worried about what to do next, at Creative Planning, we help people with that all day long. Reach out to us today at creativeplanning.com/Charlie. Schedule a call, schedule a meeting, and get a free wealth path analysis. We'll go through your entire portfolio, your financial plan, and make sure you're on the right path to financial independence. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 350 billion in assets under management and advisement, and we're here to help. So reach out today, creativeplanning.com/Charlie. Let's talk about that CPI report. Very important here, easing inflation. So as consumers are worried about higher prices a year from now, the actual data that's coming in over the past year is actually showing inflation coming down. And what we saw was both the overall headline CPI number and the core CPI number beat expectations to the downside, overall at 2.39%. And if we exclude food and energy, 2.81%. So both better than expected. Lowest level for the overall CPI since February 2021, and for the core reading, lowest since March 2021. So you're talking about 4-year lows for the CPI, not quite at the Fed's 2% target level, but moving in that direction. We'll talk about the Fed in a little bit. But if we look at that core inflation number, which is something the Fed looks at very closely, you can see the trend here, peaked in September 2022 at 6.6%. And now we're back below 3% for the first time in 4 years. Certainly good news if this trend continues. And I expect in the short term, it should continue because the biggest component of CPI overall and core CPI is that shelter component, very important in the core index. And you can see here, it's now moved down to 4%. That's the lowest level we've seen since November 2021. It peaked at 8.2%, which is the highest since 1982. And you could see the real-time data here from apartment lists in terms of what apartments are being listed at. That's still going down on a year-over-year basis. So there's a huge lag between shelter CPI and the apartment list data. And so I expect this to continue to trend lower in the near term. And if we look at gas prices, very important component in terms of consumers and consumer prices, that was down on a year-over-year basis, helping to push down that CPI. And if this holds here in terms of the month of April, you're going to see much lower CPI readings as well. You're looking here, $3.22 a gallon in the U.S., and I suspect that will come down because we saw crude oil come down significantly, and there's a lag between declines in crude oil and the price of gas. So $3.22 a gallon nationally, and a year ago, $3.61. So that differential helping CPI to be pushed down. And so what is the Cleveland Fed expecting for the next report? Looking out for April, right now they're saying CPI overall moves down to 2.42%. So going from 2.8, 2.4. So a nice decline they're expecting there. And core CPI, they're expecting to continue to trend lower as well, down to 2.76%. So the trend for CPI, at least for the next month, seems to be another lower reading. And let's talk about the Fed and what they might do in response to that data. But first, very interesting, early in the week when the market was crashing, the bond market participants were actually pricing in the Fed put coming to the rescue. And this was the data on April 8th there, the 4-day decline there being one of the biggest in history for the S&P 500. And the market was actually pricing in that the Fed was going to come in and cut rates in May. If you remember, they had been pricing in June, so that was pushed up to May. And they were actually pricing in 4 rate cuts for the year in 2025. And just a few months ago, the market was pricing in only 1 rate cut. So market participants, when the S&P was down in that bear market territory, was saying Fed's not going to just stand by and watch this. The Fed's going to come in and start cutting rates in May. And there was also chatter that the Fed was going to do something in the bond market. There's still chatter going on today about this. And maybe that'll happen in terms of the next few weeks if we continue to see 10-year, 30-year Treasury yields rise. I guess the question would be, does the Fed need to come in to counteract this if this is really selling going on by China or Japan or something else going on? Should the Fed come in and start buying Treasury bonds to counteract that and bring yields back down? There's some speculation that might occur as well. And if we see just a huge move higher in the 10-year and 30-year, I wouldn't rule that out for sure. If we look at where we are today, though, at the end of the week, after that huge snapback rally, what we actually see is the market saying, no cuts in May, only 19% probability of that happening. And so, at least for now, market back to that June scenario in terms of that first rate cut. And I think that's a function of the unemployment rate is still very low and much lower than historical average. And you have the fact that inflation isn't quite that yet there in terms of the target. And you have the uncertainty over the tariff situation. What if it actually does lead to higher prices in terms of inflation rates in the US? Well, the Fed is hesitant then to start cutting interest rates into that situation. So the Fed, I think, would prefer to see how this all shakes out and wait till June in terms of the cut, but the market might force its hand and say you should do something earlier. I wouldn't rule that out as well, but you would probably need to see market declines worsen from here. So very different situation than we saw in 2022 when we had rising inflation and we had a bear market and the Fed was not thinking about cutting rates or actually hiking rates into that very rare situation. Here we have the opposite. Inflation rates are falling. If we look at real-time inflation rates out of Truflation, they're actually showing around 1.3% over the last year, largely due, I think, in part to the collapse in commodity prices over the past few weeks over that trade war situation. So it's a lot of moving data points in terms of the inflation inputs. It's not necessarily the case, even if these tariffs are in place, that you're going to see higher inflation, because if there's an economic contraction, well, now you have demand going down, and that's going to put less pressure on prices, and you could see commodity prices come down. So it's a very complex situation. But in terms of the U.S. economy, this is how much things can change in a day. I did a poll on April 8th asking people, will the U.S. economy fall into a recession in 2025? And about 2/3 said yes. Now, a day later, after we had that 9.5% advance in the S&P 500, asked the same exact question, and that dropped to 55%. So you could see how much sentiment can change in a single day just based on the market prices, and also obviously the news of the tariffs. If it's not going to be as big of an issue, well, then a lot of the fears about recession are going to be fading away. So I'll continue to do this poll. It'll be interesting how it shifts in the coming weeks based on the shifts in the market. And if we look at the Fed for June, that seems to be the base case scenario, 62% probability of the Fed resuming their rate cuts in June. And right now, as it stands right now, the market is pricing in 3 rate cuts for the full year, which is just one more than what the Fed was projecting at their last meeting. So let's move to something positive to end this week, which was one of the most historic weeks in the market. If we take a step back, very good news we got from that inflation reading and from that last employment report is the fact that real wages in the U.S. continue to increase here, 23rd consecutive positive month for real average hourly earnings in the U.S. This is the most important chart to me in the economy because it means that prosperity is growing because wages are outpacing inflation. You could see we're almost there in terms of counteracting this 25 consecutive months of negative real wage growth. We're at 23 consecutive months now. Very good sign. And as long as the employment market holds up here, as long as people's wages continue to outpace inflation, the fears over recession are not going to turn into an actual recession. So hopefully this trend continues. This is the most important chart to watch. A lot of noise out there in terms of the markets. There's going to be a lot more volatility. But the good news is most households are in a better place today than they were 2 years ago because their wages are higher. And yes, prices have gone up. Inflation obviously is there, but the wages have outpaced inflation now for 23 consecutive months on a year-over-year basis. Okay, thank you everyone for joining me on this historic week in the markets. And if you're watching this on YouTube, hit that subscribe button for more content just like it. Have a great weekend, and I'll see you next time on the Week in Charts.